If you are at the point where you're trying to start something, birth something, believe in something, I think that you have to get to a point where you literally surrender it and trust that it's going to be what God has for you.
Many people are stuck in the place that they're in largely because of the fact that they're not around people that challenge them. And it's not that they don't know those people don't challenge them, it's that they're scared to be alone.
I am going to make a personal commitment to execution over perfection.
Right now, my company is making, over $200,000 a month.
If you give me a piece of music, what am I going to play? And you put that same, piece of music or elements of music in the hands of Michael Jackson, what is that going to create? Little becomes much when you place it in the hands of the master.
Welcome to another edition of Believers Breathe, the podcast where the aim is to help people embrace self-awareness, self-confidence, and self-worth. I do that by sitting down with proven entrepreneurs, business leaders, organizational leaders, and talking through their skill set as well as their mindset. And today, of course, I have a guest that is going to show us just that. We're going to walk through her journey, but more importantly, we're going to talk about something that is very, very important to our community, and I think is overlooked so much, and that is insurance. It's like the monster, the elephant in the room that a lot of people don't want to talk about. And so I have Valinda Burks with me today. Can you introduce yourself to the people?
Sure. Hi, my name is Valinda Burks. I have been, I'm a Nashville native, and I've been a State Farm agency owner for the last 24 years. Upcoming June 1st is my anniversary here at State Farm. I became an agent because I was passionate about helping people. I didn't exactly know how I was going to do that in my life's journey, but as it turns out, God's plan was for me to be here and do this.
So that's interesting. So I don't know of anybody that I can think of that said they wanted to do insurance growing up. So I'm wondering, is that something that you were introduced to along the way, or did you fall into it? How did it happen?
Interesting story. I started my family during my years at Tuskegee. So I started my family in college, and one of the things that I wanted to do when I was thinking about career planning, I thought about, I want to do something where I can help people. I want to do something that's flexible, that I will, be able to balance family and career. I wanted an unlimited income opportunity. I had this checklist, and really it was kind of like a prayer list, really. And I wrote it down. I didn't know exactly, I didn't get an answer at that moment. But after graduation and after kind of my family status changed a little bit, I ended up coming to Nashville, moving back home, and kind of started looking for a job. And at the time, I became a single parent and really needed the flexibility.
Yeah.
So coming to Nashville, ended up getting connected with one of my sister's friends who is a State Farm agent also, and he'd love for me to share. His name is Terry Jones. He's been a State Farm agent for years too, but he recruited me. And
I feel like I heard that name.
yeah, he is just a staple in the community. So we'll make sure we send him that information.
Okay.
But ended up being recruited by him and starting with State Farm as an underwriter. So nobody really plans to be an underwriter either, I don't think. But this is just a part of the journey.
Yeah.
And it really ends up kind of being in divine order, because some years later, I got introduced to the agency career path, and then I became an agent. And so when I looked back, probably 7 years after I started an agency, I found the sheet of paper that I had written down all the things that I was trying to accomplish. The flexibility as a parent. I've really, one of the best things about what I've done in my career is I've never missed my kids' activities and events.
That's good.
I've been able to balance my family life where I could be at the school and I could still take care of my customers, and I could make an income where, you know, they could participate and be exposed in whatever. So I really believe that this was what God intended for me to do. And the helping people and the being a resource for people, and you know, kind of helping them family plan and get to where they want to go. I mean, it's just all falling into that one sheet of paper.
That's good.
That I checked off all those things that I felt like were gifts of mine, but also things that I wanted to give.
And 24 years later,
And 24 years later,
we're right here.
I mean, it was fast.
Wow.
I hate to use the other companies, life happens fast, but
Yeah.
it has really been a ride.
That's cool. So let's contextualize insurance, because I think it is something, it's a conversation that a lot of people run from, because normally when you have to use insurance and tap into it, it's something unfortunate that happens, that transpires. And so I've been fortunate to meet an agent that is personable, and I'm able to build a relationship with, who can explain things, simplify them in a way to where I can understand it. So what exactly is insurance, the umbrella of insurance?
Insurance is buying money. So insurance is just a money purchasing product where you buy money for the time when something happens. It's triggered by something. So in simplest terms, you can look at insurance as just buying money. And really, I think what differentiates the financial foundation for most people is how much money are you willing to buy for certain situations. So if you have a car accident, you know, people call and they always want the minimum. What's the lowest I can get? I mean, if I haven't heard that once, I've heard it a million times. The lowest you can get is going to be the lowest you have when something happens. So if you are comfortable with that, then you've just set your financial life based on, you know, the minimum. And it shouldn't be difficult to make those decisions. But unfortunately, I think a lot of things roll into why we aren't exposed to insurance in that way, or why we don't look at it in that way. But basically, insurance is a foundational piece of your finances, just like your banking piece. You know, it is money purchasing. It's the other side of, you know, you borrow money, but it's the part where you secure what you have with money. And so, yeah, it's pretty simple.
I've never heard it put that way. Buying money. So the money, the premium per se, is you buying money.
It's you buying money for different things that happen that are triggered. So, for example, this morning I woke up, turned on the news, and apartment complex burned here in Nashville, a big one. And I always, you know, I'm one of those people now that I'm constantly thinking about my customers, and I looked on my phone because lately I've had to put on a do not disturb because I get calls, you know, all night. We've had a lot happen in the city. And so it's really, I've had to turn it off at some point. But I looked at my phone and I got a text message first thing this morning. You know, a customer that lived
In that
apartment complex. So, but they have bought money. I mean, they're okay. But to think that you get up, you lose all the things you work for, and you didn't spend $20 a month for the money that you could have replaced everything. And it's always kind of a hindsight thing, but that is really how, you know, what I do kind of translates into how it helps people, because of course she was devastated. It's just devastating going through something like that. But to know that, okay, it's fine, you're fine, you weren't hurt, you're still here, and you get to go shopping. All this stuff. I mean, it doesn't always work out where you feel that way, but and it's inconvenient all the time.
But to know that you can.
But to know you can replace all of your things, we're not gonna make the process hard. It's gonna be fine.
So the one that, tell us what are the various types of insurance. So from what it sounds like you just mentioned, it was like a renter's insurance. But what are the other areas of insurance?
So I try to divide insurance into stuff coverage and people coverage. Coverage for your stuff and for you. And so the stuff coverage gets to be, the auto insurance, homeowners insurance, people, get married, they have rings, pretty much anything that is valuable to you, you can insure. And then your income, that other side of it, your income protection. What would happen if you didn't go home today? The protection that you buy for your family so that their plans can go on, your dreams for your family can continue. So that's the life and disability insurance, the people side of what we protect. But literally, I don't specialize or sell this, but athletes will protect, body parts. They will, if they are a runner, they can protect their legs. Those kinds of things. You really can buy money to protect anything that's valuable to you. Isn't that amazing?
That is. So what is the process of saying, I have a ring and I want to have it insured? Do I have to get it appraised and all that good stuff?
For the most part, it's depending on how much you pay for it. But we always need, some type of summary of what it is in terms, really specifically what it is. So we'll need, the appraisal or the receipt, but those kinds of things, it gets down to the details because we want to know specifically what it is that we have to replace.
So the big one that I want to take some time to go into today is going to be life insurance, the people. And reason being is that personally, I'm in a place where, I have a daughter who is 2 going on 22, and I just had another daughter. And so legacy just feels different for me now. I was married, which is the first time, that I think I came to you, or we were pregnant about to have our first. And so obviously with the wife, I was thinking about those things, but bringing kids into the world just made me look at it completely different. And so life insurance is a tool that I'm constantly learning about, trying to figure out how I can leverage it, not only for when I leave, but even while I'm here. And so what are the different types of life insurance? What exactly does that mean? And then we'll kind of unpack, ways that we can benefit from it before something tragic happens.
Yeah, that's a whole lot in that question. That's a whole lot. Life insurance, and I guess in its simplest form, people come to me and they say, okay, I need some life insurance. And unfortunately, I think because of the commercial aspect of it, they want just the cheapest, the simplest, they don't want to think about it. They don't want to process anything. They just want, hey, I want the $19.99 special kind of thing. And life insurance is used for so many things. People don't recognize that a form of life insurance is actually used for your Social Security. The Social Security payment that you get is an annuity, and that is a form of life insurance.
Talk about that.
So, we started off at the most complicated. I kind of wanted to start off at the simplest, but the Social Security Administration basically buys a policy. It's a policy. It's a life insurance policy, and you pay into this fund. And when the fund gets big, it starts paying back out to you. So you're buying money, the same thing. They use life insurance to pay a stream of income payments, which is an annuity.
So the Social Security that is coming out of our paycheck, is that what you're referring to?
Yeah, the Social Security fund is an annuity, and an annuity is a life product. So it's kind of life insurance upside down. It's the lump sum part of the benefit that gives you a stream of income payments backwards. So you are using life insurance to pay into a fund that's making a lump sum. So the amount of premium you pay is $15, let's say, and it's creating $100,000 if something were to happen to you. So that fund is just paying in reverse. So that's what an annuity is. So it's used for annuities, it's used for pensions, it's used for death benefit. So there are a whole lot of ways that life insurance is used. And in fact, I call it secrets of the wealthy. Secrets of the wealthy, they use life insurance basically as a tool, a banking in reverse. And you may have heard of a concept of infinity banking. It's just a concept where people use loans against life insurance products to leverage purchases, because the life insurance products are the money that you put in a life insurance contract. You can use that money, and so that's how they use it. But that's a
So we're gonna come back to that.
Yeah, that's a really in-depth kind of thing.
I want the wealth secrets.
Yeah.
So with life insurance, it sounds like the cheapest is like term, right?
Right.
That's when people say, "Give me the $19.99 special. I need this term. I want to pay as little as possible per month."
Right.
What is that? What is happening in a term life insurance policy?
What is happening is that the company is basically taking a bet. Okay, they're taking a bet that within a period of time, so liken term to renting a house, liken that in terms of how you look at it. You are buying a product for a short period of time, typically 10, 15, 20, or 30 years. 30 years is an extended term, but you're buying a product for an extended period of time that's a set end date. And what the company is doing is they're using really the law of large numbers, and they're using information about your health, information about your habits, information about your lifestyle to determine what that bet looks like. So you're betting that you're going to die because that's why you're buying it. And the company is betting based on their study of you and the group that you're in that you're going to live. And so only less than 2% of term policies are actually paid. Term policies actually generate more income for life insurance companies than whole life products. And one of the things that, now what you're buying, because you let me center back to what it is. It is death benefit. So the only thing that it is death benefit. So if you pass during the time, whether it's 10 years that you agreed, 15 years that you agreed, and that we agreed as the insurance company, then we will pay the benefit if that should happen. Should that not happen, which is typically the case, then we get the bag.
The insurance company walks away with everything I've paid for 15, 20, 30 years.
Yep, we get the bag. Yep.
So basically, you said as a term insurance policyholder, I'm betting that I'm going to pass before this term is up.
Correct.
And if I don't, I'm making a conscious decision to give away all of that money, just like I would be giving it to the apartment complex that I'm renting from.
Right. Absolutely. Now, let me get back to the benefit of it. It is inexpensive. So if something were to happen, your family is protected. And that is a way that you can make sure that the next generation is better than maybe you are because you couldn't afford, the kind of policy that you have. Yesterday, I did an interview with a young lady who at 14 lost her father. And we were talking, and she told me that she has always been able to have a house with no mortgage because of the benefit that her dad gave her. So whether it's term insurance or permanent insurance, it gave her a benefit in her life. How big is that to never have had a mortgage and to have had a house?
Huge.
That's a huge benefit in life. So so don't let me in any way having any insurance is good at the time of death. So if term is what you can afford, buy all the term that you can afford.
You'll hear a lot of the critics say the opposite, that, which we'll get to whole life in just a second. But you're saying that there's more money made from term life insurance policies than other life insurance policies.
By the insurance company.
Right.
Right. Because a lot of people, the average time that people keep their term policies is 7 years. So a lot of times people let those policies lapse even before the terms are up.
Why? Because they don't want to make the payment?
Just different reasons. I mean, sometimes they replace it with other policies, or sometimes they decide, oh, I get a job and I got it at work and that's enough. I mean, a lot of reasons, but the statistics bear out that term products don't pay death benefit. The least amount of death benefit is paid by term policies. And it kind of makes sense in the sense that if you look at life expectancy is 84, 85. So at life expectancy, those term policies aren't going to be enforced because they don't renew that long. So, I mean, it is the thing where you need to sit down with someone who you trust to share your financial situation, your family situation, and make personal decisions about your life. Getting all that information from, the radio or just blurbs of it, you need to dig in a little bit and figure out what's best for you.
So can you explain exactly what the premium is and what the death benefit is? What is that?
So the premium is the amount that the customer pays for the policy. So that's the part that you buy the money. That's your part as a consumer. And the death benefit is the part that's paid if something were to happen. That's the triggered event. So let's go back to what I said about the baseline of insurance, which is buying money. So you've bought money with premium for something to happen, and that would be the death benefit.
And how much is the death benefit?
Depending on what you decide. So there's not a standard death benefit. I mean, it's not unless you're buying a policy, off of television or something like that, where they say, oh, $15,000 in death benefit or something like that. You decide, you sit down with someone, and I'm going to push that the whole time that we're talking, because I feel like, in some cases people call and they say, well, what do people do? What is the average? No, it's how much debt do you have? What are your student loans? What do you want to leave your kids? Do you want to pay for their college or no? Do you want to leave income for your family? So it's not a set amount. It's the amount that's custom to your situation. And a lot of times term can be really inexpensive. So it's not really an excuse. People, unless you're not healthy. I mean, that's the only exception to not having any life insurance. If you can't qualify for it, then your health probably
What
will
would
be
be
the
some?
reason.
Give me some health factors.
Well, morbid obesity is a health factor. Uncontrolled diabetes is a health factor. A lot of those factors can be, like, we get a lot of people that call and they say, well, I'm diabetic and I have high blood pressure. That seems to be the most prevalent in the African American community. But you can still get insurance with those. Usually they look for your control of those issues. Are you taking the proper medications? Are you visiting the doctor, when you're supposed to? So those things, and they can be rateable, which means you can pay more premium for the increased risk of what your situation dictates.
Gotcha.
But a lot of those cases, they're just not declines. And we just got information that HIV patients can now apply and be considered for life insurance.
That wasn't the case before?
No, that was not the case before.
Wow.
When HIV first started, I remember having situations where we found out with exams that some customers were HIV positive, and at that time we didn't have a product offering for them.
Oh, wow.
But that is literally new. So the advances in medicine have allowed us to be able to rate certain things that we couldn't rate before.
That is interesting. So in looking at a death benefit, if someone comes in healthy and they say, I want to get a death benefit of $100,000, that means they're going to pay their premium every month for the length of whatever term that they agree to. And in the event that they pass away, they're going to leave behind $100,000
Right.
to whoever they want.
Correct. Whomever or whatever.
What is the whatever?
A school, a organization, an institution, and that's one of the things that I'm pretty passionate about, because I feel like our institutions aren't well endowed, and a lot of times, HBCUs especially, we go, we have a great time, we get a great education, and then we leave, and we don't leave anything, as opposed to predominantly white institutions where, you know, they leave legacy. And that's the difference in, and I don't want to call any institution out per se, but if you look at the institutions that have poured so much into the Black community, a Fisk versus, which, you know, an Ivy League HBCU versus an Ivy League predominantly white institution. Look at their endowments and compare them to ours. And that gap is life insurance. Liberty University was a school that was in pretty much the same financial distress as Fisk has seen over the years. Small, same size, but Jerry Falwell, when he passed, he left Liberty University $34 million
Jeez.
in one fell swoop, which changed the whole trajectory of that institution and the financial trajectory of that institution. Just one man. So those are the kinds of things that I would love for the Black community to say, okay, let's put a intentional effort behind what we're going to leave for our institutions. Let's stop being in that space that we've been in where we're, you know, just a step away from the doors closing to prosperity. And the difference is life insurance. It's a huge impact factor. Huge, literally. And really, I hope that one thing that I leave is how passionate I am about it, because I've been doing this for so long, and I've paid a lot of death benefits. And it always seems like I pay small ones for our community and large ones for theirs.
So I've actually never heard any institution talk about what life insurance could do to change the trajectory of what they have, especially at HBCUs. I do hear a lot about alumni giving, but I don't hear about giving in that way. So thank you for sharing that. That's a very interesting way to look at life insurance.
And I think there's a reason.
Okay.
And the reason is probably the same reason where families don't. Because we're so focused on what our issues are right now that we don't plan well. So our plans are, how do we take care of the urgent and not how do we take care of what's important. And so that, I think, is the biggest thing. If we could at least balance our plans from the urgent to the important and do a little bit in the urgent and do a little bit in the important, I think that would change things in our families and with our institutions, because family is an institution. So, you know, life insurance plays in small and large. And if people would look at their family as the small institution that they are working
That's good.
on, then, you know, kind of transfer what the macro looks like too.
I agree with you. Do you have a philosophy on why you think that the Black community is thinking that way?
I think that it is just exposure and education, and and in a way, I mean, I think that it's been purposed that way. When I first started in the business, I met a agent that worked for a life company, and he was a debit agent. So a lot of people remember the man that came to your house on Saturday morning and knocked on the door, and that was the life insurance agent, and he had a little card, and it was about $4. I mean, it was literally change. And he would write down, and there would be these little policies that, you know, your grandparents would buy, you know, these little burial policies, $5,000 burial policies. Well, he would sell to, you know, North Nashville. He was the life insurance agent for my neighborhood, literally. I mean, he was, you know, kind of similar to the paper route, you know, just walk up and down the neighborhood and knock on everybody's door. But that was the method of sales in our community. And he was telling me a story about how that wasn't the method of sales in the other community. On the other side of, you know, the tracks, there was a different sales approach. And they weren't just selling, you know, small policies that were literally horrible policies. I mean, terrible policies that you pay for them for 6 years and they had paid the death benefit over and over and over again. But they were selling, you know, larger death benefits. And so over time, you know, it builds the community.
Yep.
It's the difference between, you know, leaving really a legacy and leaving a burial plot. And sometimes not even that, you know. So I think that that's the institutional part of where we have divided in this space. But just the education, just the mindset, just the thing about I'm taking care of now, and I'd rather have, you know, a nice car and you know, the stuff instead of an education for my kids if I'm not here.
So let's move to another form of life insurance. I won't take this map. I'll let you. What do you want to move to? So we talked about term. What would be another form of life insurance?
So in simple terms, there's term, which is temporary, and permanent, which is permanent. So one is for a small period of time and one is for your lifetime. And in the permanent category,
this is going to get good. Go ahead.
There are these subcategories. There are products designed to span over the lifespan of the customer. And there are a lot of those products, actually. There's a product called a universal life product, and that is a product that's a hybrid of a whole life and a term, but the design of the product is to be permanent over your entire life. And the design of the product is to be cheaper than a whole life product because they set this product up to be more affordable for people who couldn't buy term. And they also set the product up as a place to put money that would be untaxed. It would grow tax-free. So that's kind of a side story. But the universal life category even has subcategories within that. And those subcategories are fixed and variable, which fixed is a set rate of return and variable is a variable rate of return. And so this is actually just an overview when people listening to this will say, okay, I know term and I know permanent.
So let me pause you at permanent. So term, we talked about, I can set it for 5, 10, 20, 30 years. Permanent says I have it for life.
Right.
Okay.
Yeah. There's one other product in the term category. It's a return of premium product. And that's when you get all the money back that you put in it if you don't die. But the pricing for that looks permanent. So it's priced higher because you're getting all your money back, and they hold that money and they use that money, and it's priced higher. But I mean, it's still better than nothing at the end of the term, but that's in the term category too. And so now we're in the permanent category.
Okay.
And we've got a universal life product, and we've got a subcategory of index universal life, and we've got another variable universal life, and we've got just a regular fixed universal life. So those are kind of the subs in that. And just a kind of a brief explanation of understanding a universal life product is, it is a product that is designed to cover you over your entire life, but it subsidizes the term as you get older. And so if I had a whiteboard, I would draw a line of your entire life and a line going straight up, because that's the cost of insurance. And then I would draw a line that levels that off. So you're paying too much when you're young.
Too much?
You're paying more than the cost
Okay.
when you're young. And you're paying too little when you get old, because we've got that line, this line that's going straight up, and then this line that's going across. And so that is the levelizing of the premium. So it takes the money when you are paying too little, and it invests that money, so you'll have it when you're paying too much. And that might be hard to your mind's eye to see, but that's just how the product works. And the only difference in that index and that fixed and that variable is where that money is being invested that you're paying too much of when you're young. So if you can kind of
And when you
follow
say
that,
too much, is it because I'm not likely to die?
well, it's because the math behind the probability behind death is low when you're young. And remember, I told you that the insurance company looks at the group. They take, let's say they take every 35-year-old man that weighs your weight, that doesn't smoke, that doesn't drink, that doesn't have health issues, that's married, that doesn't have a bad driving record, and they take that and they know the probability of death based on that, so they can put a number on it. So it's all those factors that factor in. So a lot of times when people pay more, it's that they fall out of that category of, somebody who is really in great shape, great health, great mindset, loves the Lord. I mean, all that stuff that's going to keep you here. And so it's a price associated with your habits and with your lifestyle, and with the fact that they can look at married men and say married men live longer than single men just because of lifestyle. Isn't that interesting?
That is very interesting.
Yeah. So then permanent insurance, we talked about the UL, and then the whole life. And the whole life is just a rate, a term. I mean, it's not a term. It's an insurance product that is designed for your entire life. And it has the same impact as the universal life does, but the difference is that there's no risk to the customer, and it's not as flexible. So as long as you pay your premiums, that is going to be in effect. But these other products, if the market doesn't do well, maybe it can underfund. If other factors happen, they put a lot of flexibility in that product, so it's not as stable as the other.
So can you talk more about the product? Because I think the death benefit, we got it.
The death benefit is the same in all of them.
Right.
You can choose the death benefit. So really, that's not the variable. The variable is the cost. So the thing about this continuum of products is that the least expensive product is the term product. And then the return of premium is more expensive than that. And then the universal life is more expensive than that. And then the whole life is more expensive than that. And then we have a limited pay whole life that's more expensive than that. So that's the differentiator of these, because they all provide a death benefit. So it's time and cost.
All right. So let's talk about what comes with these products outside of the death benefit.
Okay.
So term,
Nothing.
I don't get anything unless I die within that term. Or I don't get it, the people that I'm leaving it to, or
Right.
the institution that I'm leaving it to gets it.
Right.
Then the next thing is the return of premium, which says I'm going to buy this premium or this term product, and if I outlive, let's say 20 years for instance, I live past that 20 years, the insurance company is going to technically reimburse me everything that I've been paying for the last 20 years.
Right.
Let's pause there. So at that point, if I outlive the term, do I have to renew to get insurance again?
You have to requalify. So the risk of a term is not just death, but it's needing insurance when you can't get it anymore. So, or when it becomes so expensive
That I can't afford it.
that you can't afford it.
So for somebody in my current shoes, I'm healthy, considered relatively young. 20 years from now, I won't be as I want to be as healthy, but I won't be as young. I'll be more likely to die. Therefore, the insurance company says, if we give you another term, now you're in this group of men and you're more likely to die. Therefore, we're going to make you pay more for your insurance.
Right.
Which often outprices people in their ability to pay for insurance.
Exactly. And the slope of this price versus age is 0 is right here, and then it goes straight up. I mean, it's like a straight slope up. So the cost goes, the probability of death is, higher at a older age than it is. So that's why people buy insurance on babies, because it's cheap and they lock in that rate for their entire lives.
That's good. That's good.
So at the least amount you can pay, and you can lock that in forever. You can even create a system where you only pay it for 15 years, and you don't have to pay it anymore. And when you start getting to those whole life products, they pay dividends.
The universal life product is where we got cut off, which says you have a death benefit that is permanent. And I think we need to get clarity on the product.
Yeah, so the product has within it, consider that it is a hybrid of a whole life and a term. And the way that the product works internally is that you have a term product with an account value. So the term product is basically supported by the account value. And when you are younger, it is less expensive for the cost of insurance. And then when you're older, it's more expensive, but that account value that's a part of this product holds that policy in place because it's built up this account that subsidizes the term. So all this is in the inner workings of the product. And really, I think that the decision point for the consumer is affordability and coverage. So we're kind of getting into the minutia of it so that you'll be informed of what you're buying, but at the same time your focus is, do I have enough protection for my family and can I afford it?
And how do you assess that? Because I think people say, I have these expenses and I know this is what my family would need in the event that I wasn't here, but I ain't really willing to pay that per month. Where is the happy medium when someone walks into your office? Do you push people to say, all right, let's really look and see exactly what it is that you would need?
My comfort level with customers comes from what they give me, really. If they give me that space, because I know it's important. I mean, I've been on the other side to see where, did the tennis shoes really matter? I mean, did the car payment really? Think about this. Think about what you spend money on. I had a customer whose kids didn't have a college fund yet, and she couldn't figure out how to squeeze out $100 a month to support that college fund, but she bought a new Infiniti, and the car payment was $850. So and it's a harsh reality that we buy what we like instead of what we need. I mean, that's just, we all do it. I mean, it's not anything that's specific to, so I don't want to make anybody feel bad for it. But at the end of the day, you've got to get to you about, what you really want and what you need. And there are ways, I mean, there are strategies if somebody's that interested to find them. Because think about this, over your life, you work 30 years, for retirement. You have to, those are the times where you're storing the money. But literally, people are living 30 years after retirement. So you've got to, in that lifespan, in that working span, you've got to have enough money to live, to raise a family, and to retire, and to enjoy your life. So it's a lot to balance. I mean, it's a lot to balance to say this amount of money has to be kind of partitioned into all these different areas. And some people want help with it, and some people are just like, well, I'll just get there when I get there. So it just depends on how conscientious the person is. But I will say this, I do try to get my customers to recognize if they're spenders or if they're savers. And I play to which one they are. Whole life insurance is a kind of a forced savings account. And so in a lot of cases, if you say, well, I have this amount of money and I need insurance, but I also need an emergency fund, and I also need a college savings fund, and I also need, it's a place where you can make those plans to say, well, here's one check and I'm going to use that pot for all these different areas. We can do planning like that. But most people still get funny when you say, hey, I want to spend $50. $50 ain't going to do it. Now, my whole retirement, my literally retirement strategy, a good chunk of it is with whole life insurance.
All right. So whole life is
the part where it does build cash. You lock in the rate, you lock in the insurance. That's it. I mean, you lock all that stuff in, and when I get to the end, I can use that money to subsidize my retirement. I basically turn it upside down, and then I get a stream of income payments, just like Social Security, just like an annuity, just like it can become an annuity. So I don't necessarily need the death benefit as much as I need the cash, and I will annuitize the cash. So let me give you an example of a house.
Yeah, let's do that.
So the house, you put money in the house. You live in this house. You enjoy this house. And you are paying off this house. And guess what happens after you pay it for 30 years?
What happens?
You have equity in the house. So you can actually pull money out and live off of the equity. You still have the house, but you got the cash that you built up in the house, and hopefully the house appreciated. And all that money can come back to you tax-free. Same thing in a life product. The exact same thing. The only thing you can't the payments aren't deductible. But literally, it acts in the same way. So if you like real estate, you should love life insurance.
Whole life policy says, I have a permanent policy, and I also have cash value that's building over the span of whatever amount of time. With whole life, when is it over? Do I keep paying? Die. So I just keep paying that. There's no term. I basically lock in this flat rate. So 20 years from now, I'll be paying the same thing when I'm 55 that I paid when I was 35.
Correct. Unless you buy a limited pay whole life, which gives you the flexibility of basically front loading the policy. And when I say front loading, I mean like in the first 15 years of the policy, you pay it up. In the first 20 years of the policy, you pay it up. In the first, I don't think we have a 15 pay and a 20 pay. So those policies, we have a 10 pay. So you can front load the whole entire premium for your whole lifetime in 10 years. And they're expensive. But
because you're consolidating all
those payments. But you are done with it, and the dividend structure is really good on it because you've got a lot of money in it, and they are Bentleys. I mean, that's what it is. It's probably the most exclusive contract that we that we have. And people do use those for self-employed people, especially. They use those for pensions. Businesses use those for ways to buy out partners when they do buy-sell agreements. So those are products that can be used for those kinds of things, not just typically for, life insurance.
All right, can we walk through that with actual numbers? So give me the death benefit amount, and then give me like an approximation of how this cash value can build over time.
Okay, so interest rates change, and so this example, and I hope my daughter will forgive me for using her as an example, but that's the only premium that I can think of off the top. So when my daughter graduated from college, she took a job with Google. And she called me one day and she said, "Ma," she said, "I want you to help me." She said, "I've got my first check and I want a plan. And I've listened to you and watched what you have done with other people, so, help me with this plan." I said, "Okay." I said, "How much money do you want and when?" And she said, "I want $1 million at 55. And I said, "Okay." And so I played with some numbers in the illustration. We weren't really as concerned about death benefit because she wasn't concerned about death benefit. She was concerned about the growth of her money in a tax-free environment, tax-advantaged environment. I gotta be technical.
Yeah.
And this is an asset. This is not an investment. So I want to be clear that I am not talking about life insurance as an investment. It is not an investment. An investment has timed risk. So that's not what this is. This is an asset, like a house is an asset, like cash is an asset. If you look at a financial statement and it shows assets, life insurance is a category on that asset list. So this is not an investment, and we are not speaking about investments.
Gotcha.
We're talking about assets. So she told me, she said, "I want $1 million at 55. I was like, "Okay, I need $1,000 a month for the next 15 years. And she said, "I want $500,000. And so I said, $500. No, actually, the $1 million was for $2,000 a month. That's what she wanted. And then she changed to $500,000, which was $1,000, which was more of her budget. So she bought this 15-pay policy, and at 55, contractually, it illustrates to $500,000. She bought it when she was 23. She's still paying on it, but it'll be paid up, 38? And then at 55, it will accumulate to that amount.
The cash will.
The cash.
All right.
Easy peasy.
So your daughter got into a whole life policy in which she would pay it up in 15 years. At age 23, she got into the policy.
Yep.
Meaning at 38, she's done.
Done.
But she still has the death benefit.
Right.
Meaning that whenever she does pass, the amount of the death benefit goes to whatever beneficiary.
Correct.
But she's not paying insurance anymore.
Correct.
And the policy still is building cash value.
Yes.
Even after the 15 years.
Yes. And her question to me was, "Why isn't everybody doing this?" And my answer to her is, people do what they know. And it's a lot in the airways. I mean, it's a lot of things that compete for your dollar. This is just a simple, easy way that I think people can understand. And I always tell people, don't put your money in places you don't understand where it is. Because that's when you lose it, usually, because you're confused and you don't know the inner workings of it. Learn, research, study, and put your money where you can understand it.
So the cash, how is the cash growing? Where is that money going to where it can grow like that?
Accounts. I mean, the insurance company is investing the money. They're using your money to make money. So, I mean, they're gangster. I mean, they know what they're doing. I mean, the insurance industry. And let me give you a point where something you can research and verify, fact check me. the FDIC is the banking insurer, and the FDIC bank deposits for banks with the FDIC, there are statements about where their money is. It's public information. If you go to the FDIC website, you can pull up Bank of America, and you can look at where their assets are. And they'll show you what assets they have under management, which is what they have invested. They'll show you what assets they have in real estate, common stock. They have all the asset categories. Life insurance is one of the biggest categories that banks put their money. So the book that I'm going to reference when you tell me to gives you kind of a very detailed summary of how even banks believe in life. Institutions have life insurance. And if you do what they do, then you get what they get. I mean, it's pretty simple. It's safe money. It's safe money placement because you're buying money and then the money's working for you. So as you can tell, I'm a big advocate for life insurance. And one of the things, if you talk to a stock guy, you know, he's going to tell you, buy stock. That's what they're going to tell you because that's what they have studied. That's what they know. That's what they've seen. I'm just not a risk. I'm kind of risk averse about my money. Now, I'll take risk in other areas, but, you know, when I go into the casino, I'll take what I'm going to gamble. And I put my winnings in my other pocket. And once that pocket is gone, I'm out. I'm done. I don't put what I won back on the table. And so for me, life insurance is a safe place to put, you know, to grow my money, to buy money, and it doesn't have the risk, and it has a lot of benefits. So that's what I've always done. Probably about, I would say now, maybe 15 years ago, I sat down and had a conversation with my parents about what they were going to leave me. You know, I was like, were you all planning on, do I have a trust fund, you know, that I didn't know about? They were like, no, you don't. And so, I mean, my parents gave me a great upbringing. They taught me, you know, everything and a great example, but they weren't the parents that were stashing money to leave to their kids. They were pouring into their kids as they were growing up. So I asked them, I said, would you be upset if I bought my inheritance? Would you be upset if I decided that I wanted to, you know, buy buy a life insurance policy? And it was funny because the reaction was different. My dad, he was like, oh, that's a great idea. I think it's great. If you can do something to better you and your kids and your family, and I don't have to do anything, I think that's a great idea. My mom was a little more apprehensive because, you know, people that don't know new concepts, sometimes when they don't understand it, they just veto it off the top. And so part of my retirement strategy is really buying my inheritance. So I have quite a bit of insurance on my parents that I pay for. And that's part of my retirement. And that's a tax-free benefit to me at retirement. So let's look at a 401k and let's compare the two. So you have a 401k and you have a life insurance contract. And I know what I'm going to have in my retirement because I bought it. And you're accumulating it and you're taking risk. And if anything happens, you can't get the cash unless you're penalized because it's a tax, it has tax rules associated with it. And so it's just a different strategy. So you're putting money aside to defer taxes. So instead of paying taxes now, you're going to pay taxes on when you have that big amount of money. So you're going to pay more taxes then. And I'm going to be tax-free when I have that big amount of money.
Because you're already paying it along the way.
Along the way. So to me, it just makes sense.
That's good. That is good.
But these are premiums they're significant premiums. I mean, you know, I don't want anybody to get an impression that it's an inexpensive thing to do. I mean, it is an aggressive thing to do, especially if you are catching up. Like if you didn't start saving for retirement until you were 45, 50, then you got to catch up, depending on what you want. So I use that sometimes when I sit down with customers as a catch-up strategy. If their parents are still in good enough health, because you know you still got to qualify and get permission.
That's a lot of information.
I know it is.
What I'm gonna do is run over there and I'm gonna grab a balloon, and on that balloon I want you to write one word or one phrase that you feel stands in between people and them taking a step of faith into what they want to do. So for you, it was creating that checklist, exactly what it is that you wanted to have with freedom, flexibility, family, finances, and then you made a decision to actually go and do that thing. A lot of people are handcuffed by whatever thing. So what I want you to do is think of that word or that phrase that you think handcuffs people, write it on the balloon, and we're going to pop that balloon and take the air out of it. And then I'm going to give you the opportunity to give us some resources.
Oh, wow. Okay.
All right. Be
I
right back.
think. I'm going to think. It's churchy.
That's okay. You saved and you love the Lord. There you go.
It's going to be my sermonic little message.
Sermonette.
Yeah. Okay, so this word is what keeps people from moving toward their goal.
Yep.
I don't have one word.
Use a phrase. It's okay.
Okay.
Preach, preacher.
I hope I spelled it right.
Surrender. Talk to us about it. What do you mean when you say that?
One thing that I recognized in my life as a State Farm agent is I'm a salesperson. So I am a commission-only salesperson. And living a life of 24 years when you don't know what your check is going to be or not be, you literally have a faith walk that is completely different. And the anxiety that can come when you don't learn that word is enough to really to kill you. I mean, think about it. You literally don't know if you're going to have enough for. I have employees. I have overhead expenses. I have a lot that comes with just being an agent where I can't necessarily know that I take anything home. There were times when the company actually took money from me before I got anything. I got negative checks. So I learned that my relationship with God and my trust in Him and my faith had to be, it just evolved. I mean, and it really became, I think, the strongest that it's ever been because I just had to surrender it all. And I told one of my friends the other day, I said, I sing His Eyes on the Sparrow as just every day because He has got to take care of the sparrow and me. And I've got to trust it. And so I feel like at some point you can't live in that anxious space. You can't live with, that upset. You just have to let it go. And you learn how to let it go. So if you are at the point where you're trying to start something, birth something, believe in something, I think that you have to get to a point where you literally surrender it and trust that it's going to be what God has for you.
That's good.
My kids are the same. I mean, I made lists. I'm kind of a list person. And I wrote down all the qualities I wanted as a parent to impart to my children. I wanted them to be self-sufficient. I wanted them to have a foundation in Christ, because I recognize the value in that, but I wanted them to treat people like they do, you know, and to live a life of service, and to be humble, and to be grateful, and to, you know, just be good people, and to work hard. So I got this list, right? So at some point I recognized that I had to surrender that too. You know, let it go, give it to God, and he'll make a way. And honestly, I've watched my children do things that have just blown my mind, just incredible things, you know. So on the other side of what does not surrendering look like? You know, what does that look like? It looks like holding on to the angst, and holding on to the anxiety, and holding on to the limitations, and talking yourself out of what, you know, God put in you to do. You know, so that sounds like a funny word. I know, you know, for me to write it, it didn't really necessarily fit what you said, but that to me has been the one thing that I have, talking to other entrepreneurs too. Along this journey, I've been able to meet so many people that have started businesses, and I've been able to be a part of that. And I have a friend right now that I'm kind of, I guess, trying to encourage, because truly they are gifted for it. I mean, it is no question about that. But just the thing about what they call the stability, you know, what they think is the stability of working so long all the time, being on somebody else's time frame, and also, you know, really trading something so valuable for very little. And I've just watched that, and I'm just like, let go of what you think is security, and get to where it really is where you're supposed to be. Once you let go and get on the other side, I'm not saying it's going to be easy. I'm not saying you're not going to have issues and stress, and, you know, but I'm saying you're going to be free. You know, you really will be free.
That's good.
And so, but that's a hard thing to take from academic to reality. You know, I mean, you know, theory versus the reality. Yeah, is a jump. But I've watched my daughter do it one time, and it's kind of funny that she did this. She did a video when she was about to start her business, and she was talking about a leap of faith, and I agreed with her that it's a leap of faith, but her leap had the backdrop of her mom knowing, you know, I was gonna prop her up if she fell, and she was gonna have that support. So it really wasn't falling out of an aircraft with no parachute. But a lot of us have parachutes. We have support systems. We have friends. We have mentors, people that we can go to. So a lot of us have parachutes, but we just don't trust it, because we don't want to be vulnerable to what that looks like. But that's my word.
That's good. So what we're going to do is we're going to pop this balloon and take away people's inability to surrender. All right? Cool. So first, tell us some of those resources that people can tap into to learn more about all of the stuff that we talked about. I might want to go live on Instagram, because I feel like there are other things that we could have really taken a deep dive into, but just because, like you said, it's so vast that I don't want to make it more complex for people. So just if you consider.
Well, so are we talking about it now, or we?
Yeah, I mean, at some point we can just connect, and maybe on Instagram we can allow people to ask questions that they may have.
Okay.
After going through this interview, and
okay, let's do it at another time.
Yeah.
Live for someone who is regulated by their licensure is a little complicated.
Okay.
And so I don't want to misspeak and then it create something that
it shouldn't
unintended.
Be. Yeah.
Like I said, the best thing and the best advice that I can give anybody is find someone that you trust that is qualified and experienced to help you. And I think that any information should really stay general. And when you get on Instagram, people start asking, well, this happened to me. You know, I mean, this is a specific little thing. And I just really don't want to peel the onion back like that.
Yeah.
I just, that's an important thing. And I'm very available and open to talk to anybody, but just don't want to talk to someone.
For sure.
Yeah.
So what are some of those resources?
Money, Wealth, and Life Insurance. Money, Wealth, and Life Insurance. That book is 67 pages long. And you will get a foundation, and it's not boring. You'll get a great foundation for just approaching just a foundational education about what you need to know about those topics. It's an excellent book.
Money, Wealth, and Life Insurance. Okay. And that can be found like on Amazon?
Yeah, Amazon. I tell people all the time, I spent $700 to take a seminar on that book, and the book was $14.95. And he literally verbatim took
everything in the book.
So
I ain't mad at him.
Yeah, no. Because sometimes people rather be told than read it themselves. So that's what it was. But that's a great foundational book. There are a lot of books. Rich Dad, Poor Dad. And I'm getting book titles for my son at this time, so I'm kind of remembering some of the books that I read. But books about life insurance, that one, I think I try to give it to customers if they are at the point that they're really ready to read it, because it's just 67 pages. I mean, you can read it in an afternoon, even if you read slow. Great book.
Before we close, like I mentioned at the beginning of this, I hadn't heard of anybody that went to school saying I want to do insurance or grew up saying I want to do insurance. Is this career path something that you would promote for people that may be unclear about what they want to do with their career, or they're just looking for a change? Have you been able to, obviously you've checked off your list, but is it something that people would find beneficial?
If it's for you, you'll love it. If it's not for you, you'll hate it. And think about, and at one point in my career, I thought I could sell big screen TVs easier than I could sell. People just want to buy things that they feel good about. I mean, you don't want to go buy tires for your car. You need them, but you don't want to go buy them. And that's the thing. The bank will make you buy. If you buy a car and you finance it, you're not leaving the lot without insurance. It won't happen. If you buy a house, you are not closing until you have insurance, because they're not going to take a risk that something's not going to happen before it turns over. And they're going to be protected. They don't play about it. But think about all the people who don't have life insurance and are not even close to being interested in it. And people are dying every day. Or people that don't have disability insurance, which I think is the biggest gap that people really don't have, because if you die, you're not here to deal with the bill collectors and look at your family about why you're not bringing home the money. But if you're disabled, you are here, and you are even more of a financial burden to your family, because they got to take care of you and cover the bills. But that's a big gap that people have. So this career is really, I think it's fun if you enjoy the substance of it, but it's not easy. And think, anytime it's commission only,
You gotta work.
That's not an easy thing. And I think the grind of it, I don't know if it's cut for everybody. Yeah, but I think if you love it, if you really, really care about people, if you want to hear their stories, because we hear their stories. I mean, I've grown up with my customers, and a lot of them, I watch them have kids, and their kids have kids at this point, so it's been more than just the transactions.
Yeah. How can people find you?
They can find me at, I'm on 8th Avenue. I've been here across from Zany's for a long time. And the office number is 615-292-8050. And it's ValindaBurks.com.
Cool deal. This is fun. I appreciate it.
Thanks for doing it.